I've been getting a lot of questions on how can I start investing and where should I invest. To start investing, depending on your situation, you have many options available like index funds, mutual funds, stock market, crypto and others. But before we even get there, you need to understand that behind all these options, there is a business running. Whatever option you choose, you are investing in a business. In this video, we would figure out what is happening behind that stock, behind that mutual fund that is giving you your interest and profit. We would see how do businesses function. And on the way, we learn some fundamental terms that everybody should know in the simplest of language. We'll not use many formulas, but we'll try to understand the concept actually. We will see what happens over a long period of time if you lose money in some years. And why should you invest at a reasonable price? And why should you invest in areas that you understand? So let's jump in. How do businesses function? Let's see this with an example. We are going to open a company, you and I. We are going to start a company. Let me use my example, and we are going to open Hustle Post Academy, an edtech company. For short, let's call it HPA. And how do you start a company? Well, you need to file a small form with the government and mention what do you want to name your company. So HPA in this case. Next, we need to invest some money in it, right? So that it can start its business. So let's say we are going to invest 3 lakh rupees. When you start a company in India, the share is usually of rupees 10 or rupees 100. This is called the face value of the share and is different from the market price at which the shares trade in the stock market. Now this 10 rupees or 100 rupees is a totally made up number. So depending on the price, we'll get either 30,000 shares or 3,000 shares. The total value of the investment will be same at 3 lakh rupees. Let's say we choose 100 rupees per share. I am investing 2 lakh rupees and you are investing 1 lakh rupees. Assume that we need a little bit more money to start the business. We are going to borrow 50,000 from the bank. And for this, we'll pay them 10% interest per annum. Can't we just ask bank to invest in our company and we'll give them shares? Bank is not concerned with how much profit or loss we make. Bank only needs us to pay back the amount and the 10% interest. Well, you see, by borrowing money, we are keeping the stocks to ourselves. And the benefit is, if the business makes a lot of profit, it will all come back to us. But we may also have to bear some loss. So there is relative safety in debt. You get back a fixed amount. But if you invest in equity, there is a chance you will get higher returns, but you may also face a loss. Let's take a look at this business on paper. We are going to look at something called a balance sheet. Balance sheet tells you where do you stand, what are your assets, what are your liabilities, and what is your net worth or the shareholders' equity. So we started by investing 3 lakh rupees, which we deposited in our bank account. Later, we took 50,000 loan, which got deposited in our same bank account. So this is our starting point. Let's move. We now need to start running our business. HPA is an online business. What do we need to run online businesses? We need computers and laptops. This is called an asset for the business. We'll be using these laptops for multiple years, right? This is slightly different from something like using internet connection, for which we'll be paying the bill every month. Let's see what our balance sheet looks like now. We have taken some cash and turned it into another asset. No other changes till now. Now we start running our business and we sell 325 courses during the year. Not a very big number, but let's say this was our first year in business and we are just getting our name established in the market. Let's say we are selling these courses for 2,000 rupees and we are paying 6 lakh rupees to the employee to keep running our business. To understand whether we are making a profit or a loss during the year, we'll be looking at something called profit and loss account. This is also called income statement. This is basically a statement of your income minus the expenses, showing whether you made the profit or you made a loss. Got it? For the revenue, we sold 325 courses during the year for 2,000 rupees each, making a total of 6,50,000 rupees. We paid a salary of 6 lakh rupees and we paid 500 rupees per month for internet connection, making it a total of 6,000 rupees during the year. The balance amount here is called EBITDA, earnings before interest, tax, depreciation and amortization, which is 44,000 rupees right now. Now this EBITDA is not a very relevant number. Startups mostly use this number to show to VCs that they are at least operationally profitable. On top of this, we need to charge the interest that we need to pay to the bank and the depreciation on the laptop. So let's say our laptops will wear out over 3 years. So we will charge 1/3 of the total amount to the profit and loss for 3 consecutive years. At the end of the year, after charging interest and depreciation, we have made a loss of 1000 rupees. Now the question is this a good business to stay in? We have made a loss in the first year. Let's make some projections of what the company will look like over the next 5 years. Let's assume that as we build our brand, we can charge a little more each year. So we are going to increase our prices by 10% every year. And we are going to sell to 10% more students every year. So we are building in our growth numbers. By the 5th year, we have almost 14 lakh rupees in revenue and our costs are relatively the same. Let's say we are going to offer 10% increase to our staff every year. And for the purpose of this example, every other cost is same. We'll also charge the same interest and depreciation every year. And by the 5th year, our margin is almost 33%. From this profit, we'll need to pay some taxes to the government. Let's say 30%. Even after paying the taxes, we still have 23% in the margin. Divide this net income by the number of shares and you will get the profit per share. By the 5th year, we are making almost 108 rupees per share. You remember, we had made the initial investment at 100 rupees per share. And now we are making 108 rupees per share and growing. These are just projections, but if they are reasonable, this is the kind of business that we would want to stay invested in. As the business becomes more and more profitable, we generate more and more cash, and the cash builds up in the company. This adds to the assets of the company. Our liabilities have not changed much, and the business continues to build value over time. How do you find out whether a business is good or bad for your investments? Well, one way to look at it is to figure out how much you are earning compared to what you have put in. So in this case, we had initially invested 3 lakh rupees and by the end of 5th year, we are making 3,23,000 rupees per year. This is 100% return. Our margins have grown from negative to positive 23%. This is very attractive. Let's look at how much money the bank has made. Initially, we had taken a loan of 50,000 rupees at 10% interest every year. We have paid back the bank on time every time. The bank has got its 5,000 rupees every year. We have more than 5,000 rupees in the bank account. So the loan is safe. The bank is not worried whether they'll be able to get back the amount on time or not. But they have just made 10%. Do you want to compare this loan with our investment, the equity investment? Well, in the first year, we had to bear some loss. By year 5, we are making 100% return on our investment versus the bank, which is only making 10%. So why do equity investors get to make so much more money? The answer is they took more risk. If the business had failed, the bank would be the first person to get its loan amount back. We would have sold the assets of the company, the laptop, and paid back the lender. And on top of this, if there would have been some money left, it would come back to us. Or if there was no money left, then I would have not got anything back for my 2 lakh rupees investment and you would have not got anything back for your 1 lakh rupees equity investment. But why was bank okay to take only 10% when the equity investors are getting a much higher return? Well, in the start, there was no way of knowing whether the business would be successful or not. Heck, we even made loss in the first year. The bank's only concern was whether we would be able to pay back the 50,000 plus 10% or not. If there would have been any concerns, the bank would have sold our assets, the laptops. And even if the laptops would have sold at a lower cost, the bank would have got its 50,000 back. So the bank felt safe. But the equity investor is really taking a risk. They are betting on the profitability of the business. They are taking a much higher risk that in case the business failed, they would lose the entire investment. And that's why they are entitled to a higher return. So what is the difference between debt and equity? Well, we have just seen that debt is a safer instrument. Debt gets the first claim on the assets of the company. There may be a number of types of debts that may have their own hierarchy of the claim, but you just need to understand that debts comes first. The opportunity is limited, but it is safer. Got it? But how do you understand risk? How do you compare risk? Well, the simplest way is to compare the alternatives. For example, with an FD, you could get around 6% interest. In our case, the bank was taking a higher risk. The bank could have simply invested in the FD of another bank and made 6%. But in our case, the bank was taking a higher risk, and that's why they were charging us 10%. For equity investors, the risk is based on the valuation or the market cap of the company. What is market cap? Market cap is the number of shares multiplied by the price at which they are trading in the stock market. The higher the valuation, the higher the risk in the business, and the higher the return the equity investor is going to expect. Now, our revenue growth has been around 10% per year. We think that we can grow at a higher pace if we can just increase our marketing spends. And we need more money than what HPA has currently in the bank account. So when companies need funds, they usually go to VCs. At a later stage, some companies raise funds from the public, which is called an IPO. Such companies get listed on the stock exchange. Now, we are trying to see these concepts in the context of investing. So let's see what happens during an IPO. IPO means initial public offer. It is initial because the company is raising funds from the public for the first time. And how do you do that? You need to engage a good investment banker to run the whole process. We'll prepare a document called prospectus, which will tell the public all the risks and the opportunities associated with investing in HPA. It will show how the business has performed over time. It will have a copy of the balance sheet that we talked about. It will have income statements from previous several years. The public will go through it and they will decide whether HPA is the business that they want to invest in and what is the price that they're willing to pay for it. The Securities and Exchange Board of India, SEBI, is going to ask us to list all the risks in the document. We are also going to talk about the business in that document. So it's a mix of a marketing document which will also list out the risks that people should consider before buying our stock. Now we'll sell a small part of our company, let's say 25%. But at what price? We need to decide the price for the IPO. IPO is actually a good time to get an optimally high price for the company. But if the price is too high, the public will not subscribe to the IPO. And if the price is too low, we are leaving money on the table. To figure out the price, let's talk about the valuation of the company. Now, initially, our company was valued at 3 lakh rupees, 3,000 shares at 100 rupee each. But after 5 years and so much profit, we can charge a higher price. And how do you decide that? Well, one way is to look at other listed edtech companies on the stock exchange. Let's assume another listed edtech company is trading at 20 times the profit. So we are making 108 rupees per share. So our valuation gets to be 3000 shares into 108 into 20. And that is 64,80,000 rupees in 5 years. That's pretty good. One benefit of the IPO is that our stock is now liquid. The stock is now traded on the stock exchange. If need be, we can sell more shares to the public. But because the company is now owned by public shareholders, we need to represent their interest. We need to appoint a board of directors. This is a group of individuals who represent the interests of the shareholders. Now, the purpose of this was to give you a brief about what companies are, what do they do, how do they earn profit, what reports do they provide to the investors so that the investors can figure out what the companies are worth. I hope you now have some sense of what you need to think about when you are investing. We have discussed this in our other video on the power of compounding as well. Do check it out. If you are 20 years old, your 100 rupees can turn into 4,500 rupees by the time you turn 60. If you are 30, it can turn into 1,750. And if you are 40, it can turn into 670 rupees by the time you are 60 at the rate of 10%. The simple takeaway is the earlier you start, the better. Okay, now let's talk about the risk of losing money. Assuming you wanted better returns and you invested in some risky companies to get 15% rate of return. And every 9th year, you lose half of the amount you just made due to the bad market conditions and your risky decisions. Well, your 4,500 rupees will only be worth 1,500 rupees now. The 1 crore mark that you are going to hit by the time you turn 60 will only be 43 lakh rupees. So the essence is getting higher return is not as important as avoiding significant losses over a long period of time. In your investing journey, you would come across various types of businesses, but you need to understand how does the company make money. If the business is too complicated or you do not understand, you would not be able to judge whether you should buy or not. In such cases, I would recommend you to not invest in such companies even if they have performed well historically. Think about auto industry. Before they sell even one car, they need to make huge investment in the factories and buy lots of machines and make huge investments. The machines need repair over time and they get outdated in some years. They need to invest more and more on the factories. See this graph of Maruti Suzuki India Limited. 5 years is a short time, but not many people have made money in these 5 years. Compare this to, let's say, HDFC Bank. You can see the difference, right? How much should you invest? Stock markets go through wild fluctuations in the short term. If you have enough money to take care of lifestyle in the short term, you should not worry too much. As long as you don't need that money tomorrow, you can deal with the fluctuations of the stock market. In the short term, stock market reflect what do people think, what is the market sentiment. Over the long term, however, stocks reflect the value of the underlying business. So if you are buying good companies at reasonable price and they're growing in value and you are owning them over a long period of time, you are going to make money as long as you are not forced to sell them in the short term. Investors like Warren Buffett have called the stock market a voting machine in the short term. Stocks are affected by how people are feeling in the short term. Your stock prices are affected by the events going on in the world that may have nothing to do with the value of certain companies you have invested in. So you just have to accept that what you own can go down in value. That does not necessarily mean that you have made a mistake in investing. It's just the nature of the volatility of the stock market. And how do you get comfortable with the volatility of the business? You do your own research before buying the company. Don't just buy in because your friends are buying. Make sure you understand the business. Make sure the price you are paying is reasonable compared to the earnings of the company. You would want a reasonable degree of diversification in your investments. So that one stock going down does not mean that your whole portfolio goes down. The better the quality of the businesses that you have invested in, the more concentrated your portfolio can be. Now there is no standard number on how many stocks you should invest in. It can be between 5 to 20 or more and anything in between. Just understand that you need to know everything about these businesses that you are investing in. So if you have time to keep track of 5 companies, invest in 5 companies. But you do not need to take out some time daily. Even a quarterly review would be enough. The time you spend in the market is more important than timing the market. When you try to time the market, you are effectively speculating on the market direction. But when you are focusing on your time in the market, you let the quality of the asset and the power of compounding work in your favor. According to a report on S&P Index, if you had just missed the 5 best performing days over a 20-year period from 2001 to 2020, your portfolio value would be lower by a third. And because you don't have a crystal ball, it makes sense to stay invested in the market rather than sell off and move out every time the market goes down. This is just the start of your investing journey. But I hope you now have a fair understanding of some of the terms that we use in investing. We started with how to think about businesses, what are expense, what are revenues, how do businesses make money, what is a balance sheet, what are income statements, what is the difference between debt and equity, and so much more. Also, you need to understand that investing is not only about finances, but also about how do people behave with money. So there is a lot of scope for flaws, biases, and bad behavior that you need to take care of yourself. Investing is going to be a big decision for you, whether you like it or not. It's going to have a big impact on your life now and your life after retirement. So keep learning, keep growing. If you find this video useful, press the like button. If you would like to know when more such videos are out, do click the subscribe button and press the bell icon. Wrapping it up, this is Paritosh signing off.